We're back.
We are back.
We're back. This is great. We got a new studio.
We do have a new studio. I think it looks pretty nice.
I think so. Definitely 100% legit. I don't know if you guys can see the little Batman thing on the shelf behind us, but
It's kind of far away.
It's a little bit far away. I know we had another one. Remember the
big one. The big one was cool.
Yeah, the big one was cool.
But I think it took away from we're not talking about finance. Now we're just talking about Batman.
Yeah, we love Batman.
Yep.
I see a little Batman over here, Batman over there.
Yeah, there's a couple in this room.
Yep.
But yeah, I mean, if you guys listen to us just on podcasts, go to YouTube, check us out, the Fi Guys on YouTube. You can get to see where we started and now where we are.
Oh.
You know that old podcast studio was. We're getting started. To be fair, it doesn't have to look perfect. Yeah. But it didn't look good.
It wasn't the best, but now I like where we're at now.
Oh yeah, we're moving up in the world slowly.
Fifth podcast.
Fifth podcast. Yeah, only 5 in, and we have a new studio.
Honestly, it's kind of fortuitous. 5 in, 5 guys. I don't know. Maybe I'm just stretching, but
a little bit of a stretch, but it works.
Just a little bit. But yeah, welcome back to the Fi Guys Show, where we try to demystify investment types and help you navigate this financial landscape. We are your hosts. I'm Dominic.
And I'm Chris, and today we're excited to guide you through the ins and outs of different types of investment accounts. So whether you're a seasoned investor or just dipping your toes into the world of finance, the Fi Guys podcast is designed to provide you with knowledge and the tools you need to make informed decisions about your financial future. So Dominic, if you're ready, I say we jump right in.
Yeah, let's get right into it. What are we talking about today?
Today we brought up in one of the last podcasts, and we kind of just briefly touched upon it. And what I noticed in the comments is a lot of people are asking a little bit more, like, hey, what is this Roth thing? What is this traditional? What are all these different accounts? So I thought today what we discuss is different types of investment accounts that you can actually invest in.
Okay. I love that. Yeah, let's get right into our first segment, understanding investment accounts. So what are some different, investment accounts are we talking about? Are we talking, because I've heard also, just a quick side note, I've heard investment accounts and investment vehicles. Are those similar, or is that? Yeah,
so, the world of finance, I think a lot of people don't understand what's going on because in the financial field, and there's people before me, I didn't make up these words, but they really just try to complicate things needlessly. And I think the reason they do that is to try to tell the layman person, you guys can't do this without a financial advisor.
Yeah.
Now, can a financial advisor help you to make things better? Or someone in the financial services? 100%. But that doesn't mean that you can't do it on your own. But I think a lot of finance tries to make things a little bit more complicated. So to answer your question, yes, investment account, investment vehicle, investment portfolio, these are all pretty much the same exact word.
Okay.
Maybe not portfolio. Portfolio means like the entirety of the investments. So you can have multiple accounts in one portfolio.
Okay. And different vehicles provide different abilities. Like a Roth has some tax advantages versus like other accounts, stuff like that.
Yeah, kind of think of it like a choose your character in a video game.
Street Fighter type. Yeah.
Okay. You want to have something that is 100% liquid? We can have that. You can get the money right now today. You can invest it for today and say tomorrow I need it. Go for it. If you want something that gives you some tax incentives, you can do that as well. But that means we're now looking at a longer term horizon before we can start to take that money back out.
100%. And liquid meaning, for those that don't know, liquid meaning cash that you can access quite quickly.
Yeah, and you could even have investments that you can access quite quickly.
Versus money that could be tied up and you might, based on the contract, you might not be able to touch it for a certain amount of time.
Wouldn't be on the contract, it would be on the investment vehicle that you wouldn't be able to touch it till usually a certain age.
Oh, okay.
Or if you were to meet like some underlying health issues or things like that, there's always ways to get it out without penalty.
It'd be like getting like a CD, basically, and like you put your money in it, but you can't touch it for X amount on the CD.
Yeah, and then a CD would typically be done with just a traditional account
like at a bank or something. Okay, very cool. Well, I think that was a good first step on understanding investment accounts. And if you guys have any questions, please drop them in the comments if you're watching on the YouTube video.
Yeah,
go for
please
it.
do. Yeah, just remember that like each investment account, they all have various features and benefits that are going to be tailored towards your financial goals. So it's always important that you make sure that the first step is make sure that we open up the right kind of account for you. And we're going to go into what's going to be right for you here in the next segment.
Perfect. So that's a great segue. What are some common types of investment accounts?
So there's going to be a bunch of different types. Before we get into that, what I want to get into, because I noticed a lot in the comments, was people had no idea what a Roth versus traditional was. So
Okay.
Roth accounts versus traditional accounts. So I say we go into that first, and then
Perfect.
Yep.
Perfect. Let's do it.
And the reason for that, just for our audience to know, traditional accounts and Roth accounts can be done in an IRA or in a 401k, given that your employer allows for a Roth 401k. More employers are now allowing that to come through the pipe. But let's go ahead and start with what a traditional account is. So whenever you think of a traditional account, think of delaying taxes.
Okay. Delaying taxes.
Yep.
Gotcha.
So a traditional account is going to be a tax-deferred account. So when you put money into that account, it's kind of postponing your taxes to a future date.
Under the assumption that when you retire, you're going to be making less. So you'll be in a lower tax code.
Exactly.
Tax bracket.
Yep.
Gotcha. Okay.
So you're going to put money, just say we're going to take this money now, we're going to put it into the tax-free zone.
Okay.
So
Which is the account.
the traditional account, that is the
Okay.
tax-free zone. So I made $100,000 this year.
Congratulations.
Thank you so much. I made more than that, but I made $100,000 just for an easy number.
Yeah.
And now I want to put my money into a traditional account.
Okay.
Say I can put up to $6,500 to the traditional account. So I go ahead and I do that. And now at the end of the year, when I get to file my taxes, I get to tell Uncle Sam, instead of making $100,000, I made $6,500 less than that, which would be
6,500 or 65,000?
$6,500.
Okay, so 6,500.
Sorry for quick math.
No, yeah, you're good. You're good. So 94,000, something around there.
935, yeah.
935.
Yeah.
Okay.
Yeah, and it's okay. Oh yeah, quick math. We're doing this on the fly.
Finance guy, average guy. Yeah.
Yeah, so I get to tell the IRS I only made $93,500 this year.
Okay.
Because I put that other money into my traditional account, which is now in the tax-free zone. But here's the big thing. So I get a tax break today, right? But when I retire and I start taking money out of that account,
Okay.
now the tax man shows up and says, Chris, you deferred your taxes long enough. You got to pay us that money. So whatever the amount that I put into there, plus the growth, will now be added to my ordinary income when I start to take that money out when I hit retirement.
Gotcha. And that's like your minimum distribution?
Required minimum distribution is a little bit different.
A little bit
Required
different.
minimum distributions is, that only applies to traditional accounts. So in a traditional account, if you put it into an IRA or a 401k, you cannot take that money out until you're 59 and a half as of current tax rules without taking a 10% penalty.
Okay.
Required minimum, but some people, when they reach 59 and a half, they don't need to start touching on their investment accounts.
No, they
right?
might not be ready to
Yeah.
retire. They might retire later, or maybe they just don't need the money.
People are getting older and older now, and now a lot of people aren't even retiring. Traditional age of retirement used to be 60, or it was like, back in the day, like 59.
Yeah.
Then it was originally 62, and it recently just got bumped again to 64. So now the average person's retiring at 64. So imagine you reach 59 and a half, you're still working. Well, I don't want to take my money out of my traditional account. Why do that when I can allow it to continue to grow?
Yeah.
So some people would do that, but they'll also take it to the extreme. So RMDs, required minimum distributions, is basically Uncle Sam said, Dominic, I let you defer taxes for the last 40 years. You were doing this since you were 33, now you're 73. Uncle Sam needs his money.
Yeah.
So we're going to require you to take out a certain amount every year
At a certain age.
at a certain age.
Okay.
Right now, it's 73 years old.
Because the tax man wants to get paid their taxes.
The government really, really needs taxes. Really needs tax money.
Yeah.
They really, really do.
sure.
We're running huge deficits.
Yeah.
So by allowing people to, but they also try to incentivize you to also save taxes. So just remember, you're gonna you put money in now for the traditional.
Yeah.
You get a tax break. In the future, you're gonna when you take it out, you get the growth. Plus what you put in is gonna all be added to your normal income. Will be added as if it's income in that year.
Okay, so, and that's for the traditional. That's for the traditional. Let's talk about the Roth.
Okay.
Now that we kind of got a better picture of the traditional, you're deferring taxes. Once you get to a certain age, then you have to take a certain amount out per month or per year. Okay, so that's good. So we love the deferred taxes, especially if you're rolling big, you get a huge tax bill coming up.
Yeah, and the reason that we do that is exactly what you said. Say you're a high earner now. You're making 6 figures or even 7 figures, and you're thinking, when I get to retirement, obviously I'm not going to be making as much money.
Obviously, yeah.
So I'll be able to take that money out at a lower tax bracket than I am currently. Especially if you're unmarried, if you don't own a home, if you don't have kids, you don't have any of those tax incentives.
Yeah.
Maybe it would be worth deducting some taxes now, but knowing I'm going to have to pay it in the future. Yeah. Between you and I think taxes are going to be higher in the future. So typically for younger people, lean towards a Roth. So let's talk about that.
Let's talk about the Roth IRA.
So Roth is traditional account in reverse.
In reverse.
It's real. Okay. Yep, so it's the exact same thing, but a little bit different. Think about you're going to pay now, but you're going to harvest later.
Okay. So you're paying the taxes up front.
Mm-hmm. So again, we went back to our $100,000. I made $100,000 in this year. Mm-hmm. I can put up to $6,500 into my Roth IRA. So now when I go to the end of the year, I was able to put $6,500 into that account. When I file my taxes, though, I'm still telling Uncle Sam that I made $100,000. Mm-hmm. So I'm still paying taxes on that $6,500.
On the $6,500, yeah.
But here's the cool thing about that. Mm-hmm. With me, I'm only in my 30s.
Yeah.
You're even younger than me. Just due to the nature of compounding, say you put that $6,500 into there, over the next 20, 30, 40 years, that $6,500, and say you never put another dollar in again, it's going to compound at what I like to call is the rule of 72? Yeah,
you take 72 divided by the rate or the percentage increased, and you get T for time, how long it'll take to double.
Yep. So there's the rule of 72, the rule of 105, and that's just how long it's going to take to double, how long it's going to take to triple.
Interesting.
So what I like to do for that is say we take $6,500. Let's just do 10,000.
10,000, easy now.
We have $10,000 inside this account. Mm-hmm. Now, you're in your 20s, you're not going to retire till you're 65, so we have roughly 40 years before we retire. Mm-hmm. Let's say we just put the money inside the stock market and we average very low returns, 7%.
7%, okay.
So 7 divided by 72 is going to be, for simple math, 10.
Okay.
So over every 10 years...
roughly.
Yeah, 10.2. But every 10 years, we're going to go ahead and double our money. So that means that $10,000 initial investment, when the time you are in your 30s, has now become $20,000. By the time you're in your 40s, it's now $40,000.
Gotcha.
By the time you're in your 50s, it's now $80,000. By the time you are 65 and ready to retire, that $80,000 is now $160,000. Yeah. And then that's just the nature of compounding. And that's only with a 7% rate of return.
And it's only with $10,000.
Only with $10,000. Obviously, you want to continue.
Imagine if you put $10,000 in there every year. Yep. If possible.
Here's the cool thing about the Roth. When you get to there, you have that now $160,000. You get to take that money out tax-free. So all of that money, what you put in originally, plus all of the growth, you only put in $10,000, but that $10,000 turned into $160,000. That $150,000 of growth, plus the original 10, you get to take out tax-free. You don't have to report anything to the IRS that you took out of that Roth account.
Damn, that's pretty sweet. That's pretty sweet. I heard a rumor that Albert Einstein created the rule of 72. Did you hear about that?
Well, Albert Einstein did say that the hardest thing for a man to understand is the power of compounding. Yeah. So he could,
he's a big math guy, but I heard that, I was reading a book this morning, and it was saying something about Albert Einstein, but it popped up earlier before him, but I don't know.
Yeah, I think he said compound interest is the seventh wonder of the world.
Yeah. He said it's like one of the most powerful things ever.
It is, because just you take a penny and double it every day. By the time you get to 30 days, I can't remember what it is, but
you love those videos though. Yeah, would you rather take $1 million now, or a penny?
A magic penny that doubles every day for 30 days.
Yeah, exactly. Well, that's really interesting. So the Roth, you get taxed. You do taxes up front. Get taxed up front, and when you pull the money out, you don't get taxed from the Roth. Gotcha.
So you get to just take that money, tax free. So for a lot of young people, that's kind of the way That's
the simplest way to do it.
Yeah, and another cool thing about the Roth that I really enjoy is since you already paid money on the money that you're going to put into the Roth, you can actually take your money that you contributed out tax free. So you can use it kind of as a glorified savings account. The only thing you can't take out is the growth. So let's say, again, we put in $6,500 this year. Next year, I get a flat tire or something like that, and I need an additional $400. Most people can't save a $400. Well, I put $6,500 in. Now, let's say over the next year, the account is now at like $10,000. I can still take $6,500 out of that Roth account and then bring it into my account and use it to pay bills. I just can't take the growth. So I can't take that $3,500 difference that was grown.
Gotcha. So you can only take out as much as you
put in. Obviously,
before you get taxed because of capital gains.
No, because it's the government has incentive, wants you to keep that money in the account to grow.
Okay.
So if you start to take money beyond what you put in originally, then they're going to tax you at a 10% rate, plus a penalty.
Plus a penalty. Okay.
So it's a 10% penalty, plus they add it to your highest marginal tax bracket in this year. So that's something that's only done with the Roth. A traditional account, you cannot take any of that money out.
Okay.
No matter if it's new contributions or growth until you reach 59.5 or you have an underlying medical condition that allows exemption.
Oh, that's kind of cool. So for a Roth, when can you take it out? Well, you can take it out anytime, but when can you take it out and not be taxed? Is there like an age point?
Again, it's going to be for the traditional and for the IRA, and for the Roth, it's always going to be 59.5 as of right now. That might change, and they have been talking about moving it back as people are beginning to live longer.
Yeah, 59 and a half.
Yeah, 59.5. I don't know why.
These guys. Well, that's very interesting. So we went over the two different investment types.
Yeah.
Is there another account type that you want to talk about inside this segment?
Yeah, so when we talk about the Roth and the traditional, I know that this gets a little confusing, but you can have a Roth or a traditional in an IRA. So you can have an individual retirement account that is either a Roth or an individual retirement account that is a traditional.
So IRA is an individual retirement account.
Yep.
Gotcha. Just for the listeners at home. Okay.
Individual retirement account. You can have it. You can have the Roth, or you can have a traditional, or you can have a Roth and a traditional
Inside your
investment portfolio.
And inside your initial, what was it? The IRA. I want to like say the words every time, but I know it as IRA.
Yep.
So it's like, what are these random words? Okay. Well, that's interesting.
Yeah. So you can just remember with an IRA, the real reason that I like individual retirement accounts for people is because you can contribute to it as long as you have earned income. So as long as you're making money, you can do it. Because a lot of people, they don't have access to an employer-sponsored 401k plan. People
like they would match it or something like that.
Yeah. So say you work for you work
like
for
a gas company.
You work for like a gas station or something like that, and you're not a full-time employee. Unfortunately, a lot of people aren't getting the full-time benefits that they deserve. I think it's only 25% of Americans even have access to an employer-sponsored plan. But far more than that, people are making money.
Yeah.
But they're just not saving it into actual investment accounts. Yeah. So anyone with a pulse who is making money can open up an individual retirement account.
Really?
Mm-hmm. As long as you have earned income.
I didn't know that.
And you can always contribute to a traditional account. Roth accounts have a little bit of a different amount. There are income limits that change every year as to if you go above this income limit. I think this year it's $160,000 as an individual. So if you make over $160,000 in a year, you cannot contribute to a Roth.
At all?
At all.
Really?
And there's always a loophole.
There's always a loophole. What if you get your taxable income down?
You can do that.
Okay.
So you could contribute to a traditional 401k to lower your taxable income to like 140, and then you can contribute to the Roth because you're only telling the IRS that I only made 140. Another thing you could do is contribute to a traditional IRA, and then you do something called a backdoor Roth where you convert that traditional into a Roth. That's what I do every year.
That's deep. That's down the rabbit hole right there. Good Lord.
Yep. So with individual retirement accounts, they are amazing to take advantage of it. Pretty much are suitable for anyone that makes income. The only things you have to think about is, again, with the Roth, we might have to run into some income limits to being able to contribute. And then each year, or this year in 2023, the income limit the max contribution limit is $6,500.
Okay, for the Roth.
That is, or
for both.
For both. For the IRA.
Traditional and
I could only put in $6,500. In that, and I could even do, if I wanted to, because they say I don't know where taxes are going to go, I could put $3,000 into the traditional and $3,500 into the Roth. I just can't go above $6,500 in both of those accounts.
Gotcha. Okay. So, interesting. So you can only have one of each account, though.
No, you could have 60 different. You could have, if you wanted to,
multiple accounts.
You could have 6 different IRAs. It'd be silly to do so, and then put $1,000 into each.
Yeah, but you can only invest. You can only contribute $6,500 at this point total. Really?
Amongst all the accounts.
That's interesting that they would even let you open multiple accounts.
Yeah, well, remember, there's so many different custodians, so many different places you can be. But again, for me, financial planning, what I do with my clients, it's all about simplicity.
Yeah.
If we make it too complex, you don't do it.
No.
Right? Complexity is the enemy of progress? something like that.
Something like that, yeah. So let's get on to the third account type, health savings account, HSA.
Oh, we haven't even talked about 401ks, buddy.
Oh, we haven't even talked about 401ks?
Yeah.
All right, well, let's get
Let's get into that.
Run it back.
We'll run it back at just slightly more too. So we said 6,500 for people under the age of 50. Once you reach 50, they do something called a catch-up provision, where you can now add an additional 1,000 to your IRA, meaning you can contribute 7,500 if you're 50 or older.
Okay.
Okay.
Cool.
Now we're going to talk about IRA or 401ks, 403bs, 457s, TSPs, anything that is an employer-sponsored plan.
Okay. Anything that's employer sponsored.
Yep. So 401ks typically go to for-profit businesses. 457s are usually going to be for government entities. Same with TSPs. And then 403bs are going to be usually teachers and then people that work for nonprofits.
Oh.
But they're all the exact same thing.
Okay.
You know, they're employer-sponsored plans. So the way that they work is, most people know this, if I put in a certain amount, my employer will typically match up to 3%, 5%, 6%, something like that. But that means I have to put in money, so we're both incentivized
to plan for your future.
to try to plan for your future.
And that's if you have a good employer.
Yeah.
Okay.
Yeah, a good employer. Yeah, it doesn't have to be a great employer.
Okay.
You know, so McDonald's allows it, and Starbucks has a really good plan.
Usually, like the big companies, they all have 401k matches or.
Yeah. Typically, once you get like full-time benefits, once you become like a full-time, I think that's 36 hours. Once you work 36 hours, something like that, you're eligible. Or 32 hours, I think.
32 hours.
You're eligible for full-time benefits.
Yeah, you're right. Okay. Very cool. So, anything more you want to say on those 401ks, stuff like that? Coverage matching, distributing, matching contributions, vesting.
Yeah, so for 401ks, this is usually a pretty simple one. Every advisor has their own things, but if you're getting a match at work, contribute up to that match. That is 100% return on investment.
Max it out.
Yep. No, don't max out the account. Don't max out because remember, you can put in, if you really wanted to max out a 401k, you could put in $22,500
for a 401k.
For a 401k.
Okay.
But the employer only is going to match maybe 2 or 3% of that. So at least get the match. So if the employer is going to match 3% of your paycheck,
I see.
Then you want to you're going to want to get, if you can go more, but at least get that 3%.
Okay.
At least get that 3%. That's 100% return on your money.
And what do they talk about, like maxing it out? Because I know like some people, they try to max it out every year. Is that what they're talking about? Like getting that 22,500?
Yep, 22,500 from them as an individual. Now, so they put in 22,500 and let's say their employer matched at 10%, then that means their employer can also put in $2,500 on top of that. So you would actually have $25,000 inside the account. And then again, there's a catch-up provision. So if you're over the age of 50, rather than it being 22,500 in the year of 2023, it goes up to 30,000.
Okay.
But there are some things that you need to think about whenever you do invest in a 401k. Number one, when things are in an IRA or when things are in a 401k, you have typically very limited options of what you can invest in. Because the employer, along with a plan sponsor, will choose a certain amount of investment accounts. Typically, there are higher fee mutual funds.
Oh, okay. Okay, for the 401k stuff.
For the 401ks. With the IRAs, you have since it's
total
your thing,
control.
you can do whatever you want with it. You can go and buy crypto with it. You can do whatever the heck you want.
Yeah, individual stocks.
ETFs, mutual funds if you wanted to. Another thing that's important to remember with the 401k, if you don't plan on being there for very long, there is something known as a vesting schedule. What that vesting schedule means is if you were to, the employer basically doesn't want you to leave. So what they'll say is, in year one, everything that we match you, if you quit before year one, we're going to take back 100%. So you don't get any of that 3% match. But say you stay for year two, then we'll give you 50%. If you stay for year three, we'll give you 100% of it. So if you left after year three, and then every employer is a little bit different. I've been at employers that was, they told me at the beginning it was 2 years, and then they changed it to 4 years, then they changed it to 6 years.
And they can do that?
They can.
That's baloney.
It's kind of baloney.
That is very baloney.
But yeah, they can do that, unfortunately.
Okay.
But yeah, so look at the vesting schedule because if you leave a job early, you honestly could be leaving money on the table because you're not going to get that match.
Yeah, like it might even, you might be months off. It's like, I started this job 2 years 10 months ago. It's like, oh, let's just wait another 2 months.
Just wait 2 months.
Wait
and
2 more months.
It could be an extra 8,000. It could be,
It could be a lot.
It could be a lot of money.
It could be a lot of money.
You know, I mean, imagine if it was something like at 3 years you get 100% versus at 2 years you get 50%.
Yeah,
that's
huge.
gigantic.
Gigantic.
So make sure you're looking at that because you could be leaving free money on the table. Or if you're someone who's constantly switching jobs, which is more and more normal now.
Yeah, very normal.
You know,
trading up and stuff like that, competing for salaries and stuff like that. Well, cool. And now on to account number 3. Finally, we're back on schedule. Health savings accounts.
Now the health savings account is really, really cool.
I love it. I love cool things. Let's hear it.
The reason I like the health savings account, it's actually triple taxed advantaged.
Okay.
So, triple taxed.
Yes.
So the money that we put into into an HSA is tax deductible, just like a traditional IRA or 401k.
Tax deductible.
We get tax-free growth.
Tax-free growth, really?
Just like the IRAs and the 401ks, we get tax-free growth there.
Okay.
And if we pull the money out for qualifying medical expenses, we don't have to pay taxes on it.
Like an out-of-pocket expense, kind of?
Yeah, so it could even be something like I had to go buy Band-Aids.
Really? That out-of-pocket? Interesting. I know my dad has an HSA account, and he'll usually use it for like the dentist or something like that if it doesn't cover his insurance. But you could do it for something as simple as Band-Aids?
As long as you keep your receipt.
That's wild. Yeah, because he usually sends the receipts in.
Yep.
What?
But one cool thing I like about health savings accounts is, I don't know what your dad's doing, but what a lot of people do is they'll put their money into the HSAs, health savings accounts, and then as things come up in normal life, daily life, they'll go ahead and take that money out of the account. But here's the cool thing about HSAs, and the IRS doesn't really tell people about this. There really is no limit as to when you can make a claim saying, I want my money from this event that I had to use my HSA for.
So you can go back far.
Yeah. So this is what I do.
Yeah.
If I have a qualified expense, so say I go to the dentist and I need to get a cavity or something like that where my normal deductible my high deductible, so I have to pay $500 out of pocket. I could go to my HSA account and I have, quite a couple tens of thousands of dollars in there, and I could take that $500 out of there. Or what I could do is pay $500 from my normal pocket, and then I'm going to allow the money that's in the HSA to continue to grow and grow and grow and grow and grow because it's growing tax-free.
Okay.
And then when, say I reach 59 or 60 and I say, I need that $500 or whatever, I can, as long as I still have the receipt and I digitize all my receipts in Google, I can go back and say, you know what, that $500 I took in 2023, I want that now. And then I'll claim it, take it out of huge amounts of growth over years and years and years.
Oh my God, that's so sweaty. I love that. Oh my gosh. So basically, you could just be collecting all the receipts from your out-of-pocket expenses if you had an HSA account.
Yep, so you need to have a high deductible plan first. You need to have the HSA.
Okay. But by the time you get to like 40, whatever age, the money has already continued to compound. Then you can, say, hey, I got all this money in here. Now I want it. Now I want to get paid back. What, I'm curious, at the end of, will the HSA account always be there? Like, who funds the HSA account? How does that all work?
You fund the HSA account.
You fund the HSA, okay. And it's just like an investment account. So it has a percentage where it goes up and stuff.
The only thing with the HSA is you need to have a high deductible plan. So either that is offered through your employer, which that's where most people get HSAs. And the reason they offer the HSA has that advantage is because unlike with a traditional PPO or HMO, your out-of-pocket expenses are going to be higher because they're not going to cover as much. So they're going to give you a tax advantage by being able to contribute to the HSA.
Okay.
But then you also, if I was to go to the doctor, rather than what most people do, they pay their $30 copay or whatever, I would have to actually pay for that full visit.
Gotcha.
Now, obviously, HSAs aren't that terrible, so what they do is they'll usually give you, you get to go to the dentist twice a year, you get to go to the doctor for your normal checkup, stuff like that. But if you get referred out or you do have a cavity or whatever, they're not going to cover that.
No specialists or anything like that. Okay.
Yeah, you have to pay for that typically.
Interesting.
But that could be a huge amount of money.
Yeah.
Imagine you go to see a specialist and now it's $1,000. You can take that $1,000 out of your account right now, or you can take it out of your pocketbook if you have the money available. And then that $1,000, given the rule of 72, and over the next 40 years, could be upwards of $8,000. It could be $8,000.
Wow. Yeah, I didn't know there wasn't a time limit on the HSA coming back.
Nope. The most important thing though is that you keep the receipts. Digitize the receipts, because without that, because whenever you make a claim, all you have to do is go online to your brokerage. So even if you left your employer, that HSA is still yours.
Yeah.
You can move them along, move them different places. You can roll them into new HSAs. Yeah. But you just go in there and say, hey, I want to make a claim, and you just submit the receipt. Sometimes you don't even have to submit the receipt, but if you get audited by the IRS, you want to have that receipt available, or that you're going to get in trouble. Okay. And then one thing that's a little bit different between an HSA and a 401k.
Okay.
With a 401k, I said you can contribute up to $22,500, and then your employer can match whatever they match on top of that. With an HSA, you can only contribute in this year, 2023, $3,850. That is between you and your employer.
Okay.
So let's say you put in $3,000 and your employer puts in the other $850. That's all that can go in there.
That's all that can be in the HSA account
For this year, for 2023, 2024.
That's all you can add.
For 2023.
Okay.
And then if you have a family plan, because you can do these for individuals or families.
Okay.
If you have a family plan, then it's $7,750.
Okay. Dang. And then if you're like over 55, there's like a
then there's still just like that. There's still a catch-up provision of an additional $1,000.
Okay.
Yeah, but that's a big thing that's really important is, just because if you put in, most employers, if you contribute to an HSA, are also going to give you a match, much like a 401k.
Yeah. Interesting. Okay. That's very interesting. Where do you want to go from there? Do you want to go to the account type 4? Are we ready to go there?
Yeah.
Awesome. Taxable brokerage accounts. So let's talk about the different retirement accounts.
Yeah. So we've talked about all the qualified accounts, and qualified just means that it gives you special tax incentives. So we talked about the 401k, the IRA, the HSA. Those, again, they all had something special with them when it came to taxes. Now we're going to move on to the normal taxable account, also known as a TOD account, transfer on death account. It could just be, some people call it a brokerage account,
Okay.
a non-qualified account. There's so many different names for this type of account, but it's basically, it's just normal funds.
There's no limit. There's not too many rules with this one.
There's like no rules with this one.
No rules. You can put as much as you want in there. You can take as much out. It's basically just an investment.
Yep.
So maybe I'm curious what you think about this. Should you only start one of these once you've maxed out the other accounts?
That is a really good question.
Yeah.
And just like all financial advisors say, it depends.
It depends on who you are.
It depends on you. It depends on your liquidity needs. It depends on your long-term goals.
True.
So for me, I have enough money in my savings account that I feel comfortable to be able to hit any, if any issues happen, I have the security deposit. So that's what I do. I will max out my, since I own my own business, I have a solo 401k. So I max out my solo 401k. Then I max out my Roth. Then I do my I do my HSA, then my Roth, and then anything that's left over will go into my taxable brokerage account. But for some people, that might not be the most ideal thing to do because they might need that liquidity, that they can't lock their money up till they're age 59 and a half.
Yeah.
Without paying a
They got
penalty
bills
on
to
it.
pay.
And bills to pay.
Stuff like that.
Or some people might use this as like a place to park some money that maybe they're real estate investors. And they're like, oh, I need some
Waiting for the next deal.
Waiting for the next deal. They can put some money inside here. It wouldn't make sense to put it into a Roth account or a traditional account.
Because you can only put so much.
And you can't get it out to your 59 and a half.
Yeah.
Real estate deals can come around
quickly.
And you don't want to wait.
So for like they wouldn't put their money in like a taxable brokerage account though, because you'd have to pull the money out and you'd be taxed on it, right?
It is, well, yeah, you're still going to have to pay it. So it's going to have to go into a taxable brokerage account. What means the money that you're putting in there has already been taxed, and then all the growth on that is going to be taxed.
So it's pre-taxed.
No, it's post-taxed.
It's post-taxed.
And post-taxed. It's getting taxed every which way.
From every angle.
Every angle is getting taxed, but but it also gives you maximum ability to get that money at any time.
Okay, so high in liquidity, high in taxes, but it's also the average person. They're usually not going to have this though.
They should. I would hope.
You think they should?
I would hope they would. This is where most people start out with, like Robinhood accounts.
Oh, okay.
When most people open up a Robinhood account, it's not an IRA. They just open up a normal one.
Just a regular brokerage account.
So that'd be a traditional. That'd be a taxable account, a TOD account.
Okay.
Just remember that all the capital gains, which means all the growth you get in the account is going to be taxed whenever you sell.
Yes. So you're taxed not when you pull out, but when you sell.
When you sell.
Okay.
All the dividends,
All the
that
dividends.
come to you, as the dividends come, are getting taxed.
Okay.
Um,
And when you pull out the money. Mm-hmm. And when you put in the money too.
no, not when you put in the
Not
money,
when you
but
put-
remember the money you put in has already been taxed because you have that.
Because you already paid.
Because you already
Gotcha.
paid, when you got your paycheck,
Yeah.
that money's already been taxed.
Yep. And yeah, it's not deductible. It's not like a deductible on taxes every year.
No, not like a traditional or a
Not-
401k. You don't
Gotcha.
you can't deduct it. So if I put $10,000 into my taxable account, I can't tell the IRS, well, I put $10,000 into my taxable account. I think I deserve to pay you $10,000 less in taxes.
The only way you can take a tax advantage on a taxable account is if you lose money.
Yes, you can.
You can write off your losses.
You can write off your losses up to $3,000 this year.
Up to 3,000. Only up to 3,000? Mm-hmm. Okay, cool.
Yep.
I'll write those off. Just kidding.
Yeah.
Okay, that's very, very interesting. I like what we've talked about today. I definitely liked what we've talked about. Would you like to go into the next segment, or is there anything
Yeah, of
else you want
course.
to cover on?
I think you touched upon it a few different times. Asking like, well, which account is right for you?
Mm-hmm.
And again, it always depends. And please reach out to your own financial advisor or to a professional. You can even reach out to me if you need to. We'll put my link into the descriptions. I'd be happy to help and talk with anybody. But there's things we got to consider. We got to consider our risk tolerance and our investment goals, our time horizon, and our liquidity needs. And then there's also tax implication and the investment strategies we're going to put into each account. Mm-hmm. So, for example, if we have an account that is going to be buying and selling and giving us a lot of dividends, we're probably going to want to do that inside of a qualified account. So either one of the IRAs, because we don't want to have a bunch of dividends and a bunch of things going on.
Getting taxed.
Yeah, getting taxed. So typically what I recommend for taxable accounts is that's going to be your long-term buy and holds. We don't want to be buying or selling and buying a lot inside those accounts because every time you do that, you create a taxable event.
Gotcha.
Now, don't get me wrong, we always put good investment allocations over taxes.
Yeah, of course.
But
of course.
if we're really trying to maximize things, let's
Yeah.
really try to maximize things.
Interesting. Yeah, that's very interesting. I think.
Do you have any questions when it comes to, from the audience standpoint, things that I might have not been clear enough on?
I think what's the first maybe 3 steps a person can take if they don't know where they're at?
If you have no idea where you're at, again, it's going to first come down to how much money can I contribute safely. Mm-hmm. If you really have no idea what you're doing, I'm going to assume you're probably below Roth income limits.
Okay.
You're probably still getting started, somewhere like that. So I would typically recommend using a Roth IRA.
Okay.
And the reason I recommend that is because, again, you can take whatever you put into there, you can take it out as a savings account. Obviously, don't do that if you don't have to. We want to keep the money in there growing as long as we can.
Yeah.
But it's kind of like a glorified savings account.
Okay.
So Roth is usually the best way to go. Traditional is also good. They all work. Mm-hmm. First things first, though, is if you have an employer-sponsored plan, get that match.
Yes.
Then from there, maybe look at a Roth IRA or a traditional IRA, depending on what you're looking for.
So seeing if your employer matches your IRA.
Your 401k.
Your 401k.
Or 403b or whatever your sponsored
whatever
plan
your
is.
plan is. Okay.
Get that match.
Get the match. Yeah.
And then, before we're doing any of this stuff, we need to make sure also we have the good financial habits. We don't have any credit card debt, anything like that.
Yeah. There's levels to it.
There's levels to
There's
this.
definitely levels to it.
Yeah.
Okay, that's very interesting. So getting started, that's basically how you would want to get started. Opening an investment account. Do you want to talk a little bit about that?
Yeah, you can always go to Vanguard, you can go to Fidelity, you can go to M1 Finance. There are so many different custodians you can go to use. The reason I really like Vanguard a lot. They're the ones that I started with personally. I don't use them as much anymore because I've kind of grown past them. But they have some of the lowest cost index funds that you can get.
Okay. And you have to open an account with these people to buy their index funds, or could I be in Webull or Robinhood?
You can.
Okay.
You can, but it depends. Some funds are going to be exclusive to Fidelity, exclusive to Vanguard. But for the most part, yes. And even if you don't have the exact same one, so maybe I can't get a Vanguard fund at Fidelity, but Fidelity is going to have an equivalent fund at Fidelity that's doing the exact same thing.
Okay.
Might have a slightly higher expense ratio, maybe not. There's things you can always look at.
And I would say just sitting here, it definitely would help having a good financial advisor walking you through this.
Yeah, because again, it gets really complicated real fast. We've only talked about 4 different accounts, and we've taken up I don't know how much time just to do that. 45 minutes
probably, yeah.
Just to do that, and that's the reason that so many people, when they start trying to learn about finance, they just throw their hands up in the air and say like, "This isn't worth it. It's too difficult," and they end up doing nothing. And then unfortunately, as financial advisors, most advisors try to make this far more complicated than it is to try to justify the client paying a fee to them to manage all of it. Is it complicated? 100% it is. It is complicated, but anyone can do this, but they have to put time and dedication into that. And if they're at a place in their life they say, I don't have the time or the discipline or the desire to do that, then reach out to somebody. Reach out to me. You can go to monsonwealth.com. You can always go and do that. You can even reach out through YouTube, and I'd be happy to at least set up a consultation or get you some free resources to get you on the path.
Yeah, absolutely. I know you have a quiz on your website that's pretty neat.
Yeah, it's kind of fun. To try to see where you are on the path to financial independence. That's the reason we really started this podcast, right? I was meeting with individual people and helping them along a little bit, but that's not scalable in any way. I'm helping one person
at a time.
1 person a day typically, because I'm not going to back them up. I have to focus on things that actually bring in money.
Yeah.
So that's what I was hoping with the podcast, is that we can take this kind of stuff, actually come from a professional advisor, not just from some guy on TikTok who's telling you what to do.
Those TikTok ones are pretty wild.
Yeah, I met with a couple this past weekend, and one of the questions I typically ask is, where do you guys get your financial advice from? And just the myriad of answers I get is that was one of the big reasons that spurred me. We need to actually get good content out there.
Yeah.
To try to help people as much.
I'm telling you, we got to start on the reaction videos.
I
would love that.
Yeah,
I would love that. That'd be funny.
Okay.
If you guys don't know what we're talking about, Chris and I were talking about like us watching like different financial content. Thank you. On YouTube. And we would be giving our advice on it and seeing, is this Five Guys approved or is this, Five Guys disproved? Is this crap or is it good? Yeah. And
because there's just so much information out there, and even different good advisors will give different information. For me, there was a firm that I worked for that thought it was very dangerous for me to teach people how to credit card hack and how to do that kind of stuff. That's something that I bring to my clients, is teach them how to do that, because I think it's really important that we're not only focusing on the future. We also need to focus on living right now.
Absolutely.
But some people, there's some places that say like, no, don't do that, because not enough people are saving, which is true. Not enough people are saving, but I think we can still find a balance of saving enough and planning for your future while still living for today.
Absolutely. So, should we get on to our next segment?
Yeah, I think we're really.
Are we at the end already?
It,
Already? Gotta wait till next week, guys? Dang. So to summarize some of the takeaways from today's episode, Roth IRA, traditional IRA.
Roth 401k, traditional 401k, and 403b, any employer sponsored. HSAs.
Okay.
HSAs are health savings accounts. That's the one that gives you the triple tax advantage.
Yep.
Those are fun, but you have to be in a high deductible plan to be able to do that.
Yeah, so it might not be for everyone.
Yeah, probably not. If you have a bunch of medical expenses, if you're someone that has to go to the doctor often, if you have some sort of underlying medical condition, HSA is probably not going to be the way to go for you.
Gotcha.
Because you're going to be spending more than if you just got a PPO where you're just paying the deductibles.
That makes sense.
But if you're a healthy young guy like ourselves, shoot, even if I could go to the doctor, I do not like going to the doctor. So I just don't go very often. I go to the dentist. That's it.
The dentist is important. Go to the dentist.
Go to the dentist.
Get your teeth cleaned.
Floss your teeth.
Floss.
Go to the dentist.
Some mouthwash. Electric toothbrush.
Do your best.
2 times a day.
And then after the HSA, then we talked about the traditional, just standard brokerage account. These are going to be taxed, the money that goes in, tax the money that grows on it.
Yep.
So everything kind of taxed, but you can get the money out at any time.
The taxable brokerage accounts, you get taxed in like multiple ways. It's not ideal.
But again, if you need the money, then that's the way to go.
But it's the most liquid.
It's the most liquid, 100%. Because
And
the other ones you
people
can't
have.
access to your 59.5.
No, but that's what most people have though, right? Is the tax, like when you open up, like you were saying, a Robinhood account, a Webull account, a TD Ameritrade account. Usually, it's just a regular brokerage account for trading stocks.
And remember, because you asked about like writing off losses, you can only do that in a taxable account. You can't write off losses in an IRA.
No.
Because again, you haven't actually solidified that loss until you take the money out, which shouldn't happen until you're 59.5.
Could you carry over the loss to next year?
For what?
I don't know. I saw something. I was doing my taxes last year, and it was like one of the stocks was like down. I was like, I'm gonna see if I can write this off, and it was like you can carry this loss over. So I was like,
You can, yes,
You can?
in a taxable
in
account.
a taxable account.
You can't do it in
Okay.
the IRAs.
I think that's what it was then. Okay, that's interesting.
Yeah, then we talked a little bit about like risk tolerances, investment goals, your time horizon, your liquidity needs for selecting different types of investments. Sorry.
If you guys don't know, it's very it's dry out here in Arizona. My mouth is like cotton. So if you see us taking a couple sips of water, don't kill us in the comment section.
Then we talked. Sorry. Then we
you're
talked a
good.
little bit about tax implications and investment goals. Then we talked just a little bit about what you can do to open an account. You know, if you need help, please reach out to your local financial advisor. If you trust us, you can always reach out to me. You can go to chris@monzonwealth.com. My name is Chris Monzon, so chris@monzonwealth.com. We'll link the the website in the description, and there's a contact me page on there. So I'd be happy to talk with you guys, and even if you don't become a client, I'd be happy just to get you some resources to get you on the way.
Absolutely. And also, like, when choosing a financial advisor, like someone like you are a fiduciary. So that's important when choosing one because they make decisions in your best interest as if it was their own money.
Yep.
Okay.
Yeah, there's a lot of people out there, and that kind of comes into the finding your financial advice. There's so many people out there that claim to be financial advisors, but what they really are just salesmen.
Yeah.
They're insurance salesmen,
Yeah.
stuff like that. I'm sure we've all seen those guys come knock on the door and say, hey,
Yeah.
I'm a financial advisor, let me help you. And they're
Yeah.
just trying to sell you a whole life policy or something like that.
Yeah. That's exactly right.
So, listeners, thank you so much for listening in. Check us out on YouTube, but we're going to be getting on Instagram soon and Facebook.
Maybe even on TikTok.
We
should be on TikTok.
We should do TikTok.
By the time this is out, we'll be.
I think we'll do a TikTok. So get on there. Please like and subscribe. Again, take one actionable step today.
Yep.
What's your actionable step going to be today, Dom?
My actionable step today is probably going over the show notes and seeing where I can improve for the podcast, but in a financial sense. Is definitely looking more into that HSA account, looking into those different traditional accounts and seeing where I can better restructure my finance, basically.
Yeah. Good. I'm glad you're going to do that. I think what I'm going to do is I'm going to get a little bit more on social media, try to reach out to more people. You know what I would really like to do, and let us know if there's something you would like, is kind of do like a listener mailbag, maybe either once a week or just maybe do something at the end of each podcast where we just kind of give, someone sends us in, this is what's going on, and we'll just kind of give our thoughts.
I love it.
You like that?
Yeah, that'd be fun.
Cool. Well, check us out on all social media, guys. Again, this has been the Fi Guys, and we'll see you next week.
See you guys.
Later. This podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. Always consult a financial professional before making any financial decisions. We do not endorse specific products or services. Past performance doesn't guarantee future results. The opinions expressed are those of the hosts and guests and not of the podcast sponsor.